welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with Jim Riggio, and our guest today is Marc Principato. And before we get started, I'll go over a quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented, but actual profit or loss may vary due to market factors such as liquidity, slippage, and commission. And our disclaimer is on our website at the footer if you ever want to go through it word by word. But that's it for the disclaimer. So, Marc, it's a pleasure to have you back. And we had you on with a market analysis a couple weeks ago.
Yep. Thanks. Nice to be back. Okay, so I guess.
Yeah, I just made you the presenter. So if you want to introduce yourself to the people that don't know you, and then maybe go ahead with your presentation.
Okay, great. All right. So hello, everybody. Thank you, Tom, and thank you, Jim, for having me here again as a guest. This is always a great honor to be working with you guys. For those of you who don't know me, my name is Marc Principato. I'm a chartered market technician. I've been director of Forex and Futures at S&B Capital for a couple of years, and I operate a website called unconventionaltrader.com. Basically, what I am is a very short-term trader, scalper, day trader, and very short-term swing trader. I'm a directional trader. So Tom had asked me to come on here to do a little presentation about how my methodology can be useful for options traders who are interested in learning more about how to trade in a directional way. Because I understand, options traders are always looking for non-directional things and trying to make money on time premiums. But there are ways that you can anticipate market direction, and that's what I'm going to talk about here today. Okay, so a little bit more about me. I've traded stocks, futures, and Forex for a number of years. I've been focusing mostly on futures and Forex now for, since 2008, 2009. I've been mostly focused on that. But I pretty much trade everything, and I'm a short-term trader. That's my background. I'm also a price action trader. So I'm a discretionary trader. I focus mostly on price action, and that's what you're going to see a little bit more about here today in my presentation. Okay, so can I share my charts? Or Tom, is there anything else you want to say before I begin?
No, just that, the options industry, we're looking for, in general, probably where the market's not going, and if you can help with some clues with that, that'd be great. I know a lot of people could learn a lot from it.
Well, Marc, one thing I'd like to end up adding, and this is not so much for you, but it's for our audience. I've spent a lot of time over the last 6 months to a year working with some professional traders, background of former Goldman Sachs options traders and things like that. And what I've seen them do is something that a lot of the option communities don't talk about. When we've had such an increase in our daily ranges, instead of becoming options premium pure sellers, trying to sell iron condors or wider butterflies, what I've seen many of them do with great success is put on trades that are directional but have limited risk. Things like well below the money butterflies or broken wing butterflies above or below the money. A lot of times having with butterflies having 1 to 4, 1 to 6 ratios, risk 1 to make 6. And so if they're wrong, it doesn't make any difference. If they do get the violent move back in some of the market direction stuff that you're going to be talking about, there are just wonderful payoffs. So there are ways to actually limit your risk, have great risk rewards, and use some of the technicals that we're going to talk about today.
Oh, that's great to hear, Jim. It's very interesting because, when you have this type of technique that I'm going to show you, what it really helps you do is anticipate, where these turning points, these high potential turning points can be, and you can be prepared for them instead of just reacting to them. So if you're putting on these type of positions in these opportune areas, especially after there's some form of confirmation, and then you're not worried about it because you're only risking 1 to make 6. I mean, I can't think of a better trade than that. But
yeah.
okay. So
It's been working just absolutely wonderfully. You know, one of the things that as we have been showing the premise of in all of our trading systems to hedge fund sponsors, okay, it always comes down to what's your risk management, how do you limit risk on the downside, and then once you have the risk limited, because, you know, as options traders, we're always taught about risk-defined trades, then it just becomes a simple game of, you know, probability and statistics.
Right. Right, and all around, even the technique that I practice is really all about as well. It's just my job requires a lot more attention. I really have to focus on things because I'm so quick, you know, with my decision making. But that's for day trading and scalping. You know, applying this thing to a larger time frame, the concepts are the same. Obviously, there has to be different adjustments, especially when it comes to risk. You know, so I'm going to try to share my desktop right now. I'm going to see if this works, Tom. Let's see what happens.
I see it loading.
Yep.
Yep, there it is.
See it? Okay.
Yep.
Great. So this is my disclaimer that I put on all my stuff. Anyway, it's very similar to yours, so I guess I'll just mention I carry no relevant positions for educational purposes only, and I'm not a broker-dealer. It's the same idea, pretty much. But, you know, so anyway, just mentioning that. Now, so I have some slides I'm going to go through, and I have a couple of charts. I'm going to go to my real-time. I have some real-time charts that I'm going to show some examples on. And I have a chart that one of my trainees sent me that shows a nice example using the stock. Okay, so again, this methodology is a directional methodology that I use for straight futures trading, you know, or stock trading. So I'm usually not applying options, although I actually did a session about applying options to this, and the particular strategies that I think are most friendly for this kind of thing would be straight options like calls or puts alone, short calls, that means, you know, short calls or puts, which I know people hesitate on because of the risk. But if you have the ability to watch these things all day, you know, it's not a bad idea considering you're already entering at a high probability point, which I'll explain further in a moment. Also, this is good for credit spreads, okay? You know, basically like short verticals. Just collecting those premiums because, again, you're getting in at very high probability prices. Even a small turn in the market is going to knock that premium out. So, you know, it really puts you in a high probability position. That's the whole idea. So as I go into this, I'm going to be adjusting it for options traders. Just keep in mind, this is more, you know, the premise comes from just straight futures trading. So first thing I want to share is the premise, you know, the idea. What are we exactly doing? What am I trying to exploit? It's a natural market process. So basically, when reactionary traders are wrong, and there's a large group of them, they get caught. The result is usually they get forced out of a position, right? And this causes a repetitive market process known as the false breakout. This is the idea behind what I try to capitalize on. When a lot of people are caught and they're wrong, I want to be on the other side of that because when they get forced out of their trades, all those stops and everything, all that reaction that's happening, I can basically take advantage of that movement and get out, you know, on that same movement. So it gives me a very high probability position and natural process to depend on. What's nice about the process is it's repetitive and it can be identified objectively. So I can just do that over and over again. That's really the idea. Without that kind of premise, I'm just gambling. Okay, so this gives me an advantage because I'm hunting for a natural process. I'm looking for these people to be on the wrong side. And the steps that are involved in my methodology help me to identify these areas ahead of time, look for validation or confirmation at the time we reach a level, and then after that, of course, comes trade management, which then at that point I'm listening. I'm listening for new information to see how I need to adjust. Keep in mind, I'm doing this minute to minute, you know, or like, you know, within minutes or hours, not days or weeks. As an options trader, you would be thinking of this in terms of days or weeks, okay? So it's a different magnitude. So that's the first thing. This is the concept that we're going after. Everybody knows the false breakout. I'm sure we've all been caught in them. So the next thing is this methodology, I like to conduct it. It has two parts. There's the analysis part, and then, of course, there's the trading part. The analysis part is the first half. We're gathering information so that we have perspective, and that's the first step that I'm explaining here. All right, this is actually a four-step process. first two steps are analysis. The second two steps have to do with trading. Different skills involved in each of the steps. So when I'm gathering perspective, what I'm doing, and this is pretty simple, it's pretty straightforward, I'm asking questions. I want to know what the trend is, okay? I want to have a sense of, are we strong or are we weak? But not just on one time frame or one magnitude, but on many. So I like to separate it or categorize it into three magnitudes, right? We have the bigger picture, the medium picture, and the small picture. It's simple enough. But the question is, how does this affect our expectations? So let me go to a chart real quick, and let me give you an idea of how this works. So what I have here is the SPDR ETF. I do this with futures, like I said, but you can do this with stock ETFs. You can do this with stocks, all right? The first thing that I do is I zoom out. I go back. You notice this is a 240-minute chart. This is a 4-hour chart. Each bar is 4 hours. I can look at a daily, but I like 4-hour charts because it gives me just a little bit more detail. All right, for my purposes especially, this is a very large time frame. Now, what I'm looking for here are just, clear signs of a trend. Do I have higher lows and higher highs? Yes, I do. Okay, for the most part, except for this new little movement right here, this relatively new sell-off. But before then, I could say that this wasn't a clear-cut uptrend. That's going to affect my expectations moving forward on the big picture. But that's my big picture, going back months, all right? But what about going back weeks? Okay, my medium picture, what is that? That would basically take up maybe a month or two of data, something like that, okay? And in that span of time, I could say my trend is bearish to neutral, okay? Because, we made a lower low. We haven't made a lower high yet. We have to see what this thing does, all right? Because this thing may push up to new highs, possible. I don't know. I can't make predictions. I just go by what the market tells me. Okay, so that's our medium picture. So I'm looking at more of a bearish to neutral market. And then my small picture is my most immediate price action, which would be this section right here. My most immediate swing, which is bullish. Now, that may sound confusing to people because it's like, all right, I just finished talking about bullish to bearish back to bullish. But this, again, is going to affect how I manage my positions going forward. As an options swing trader, it's important to pay more attention to the medium and bigger picture because that's really where you're going to be getting your cues from, all right? Because when the bigger picture asserts itself, that is when you have these broader moves, right? And as an options trader, opening up a type of position that I'm going to discuss, you're looking for a broader move. This isn't something you're going to be, trading day in and day out. This is something that takes some time to develop, and then once it goes, you're going to be in it for days, maybe a week or two, okay? So you're looking for those broader moves. That means no, 30-minute charts, no 15-minute charts. We're going to be spending time on hourly, 4-hour, or above. So the first step, like I said, we identified these three magnitudes. My most immediate is bullish. Wouldn't it be nice if you were able to anticipate this point here before it happened, right? As an options trader, of course it would be nice, even as a futures trader. As an options trader, if you knew about this point, you can basically look to open your positions just below, all right, as long as there's some validation in this point. Remember, you're not going to get it at the absolute bottom, but if you're getting it in the zone, somewhere in the zone, you're still going to have access to a decent premium, all right? But we'll talk about that when we get into the time horizon on the options. But anyway, so I'm still pointing out the first step of the methodology, okay? So that's our first step. We're gathering perspective. Now, when I'm doing that, I also want to get a sense of, like I said, immediate momentum, and that's right now bullish. Once I have all this figured out, okay, which doesn't take too long, especially for this type of time frame, the second step, all right, let me go back to my slides here, are going to be levels. But let me just mention one thing before I go forward is the question, how does this affect our expectations? If we're bullish, okay, on our bigger picture, our medium picture is slightly bearish to neutral, this is going to affect how I treat longs and shorts, okay? If I'm looking to be long and we have a generally bullish environment, then I want to expect more from my longs. This is going to be important if I'm straight calls or puts, okay? Obviously, for longs, straight calls. Then I'm going to want to be more aggressive or expect more or have a higher target if we're generally bullish. Okay, if we're generally bearish, then I should be expecting more from my straight puts. Okay, that's pretty obvious. But you'd be surprised how many people don't consider this. They get too caught up with a lot of noise. But it's like, which side should we be more aggressive, or which side should we be more conservative? If I'm short calls, or if I'm short puts, or I have a bearish spread on where I'm collecting time premium, then it doesn't matter as much because now I'm dependent more on time. Okay, then instead of expecting more or less from price, I'm more dependent on time. So even if price doesn't make it very far, if we waste time, then that can be helpful as long as it's going sort of in my direction, right? So that's what I mean by expectations. It's very important to have expectations going into the trade before you actually have this thing on, because you need to know how to adjust if there comes a time, if the market is not doing what we're expecting it to do. Okay? So that all encompasses the first step, which is perspective. Let me just ask a question real quick. Do I have any questions? Can I see people's questions, or should I just go straight on without asking for questions?
I am going to do any questions yet.
Okay. Well, if you have any quick ones, I'll answer them. If not, we'll do the Q&A when I'm 45 minutes into this. We'll do a Q&A. Okay, that's probably the best way to do it. Okay, so the next step is support and resistance. Also what I like to call levels. So there are a number of variations on this. For purposes of this training here, I'm just going to talk about extreme prices. Now, extreme prices are an area or a zone that I look for in price action, and it usually relates to a previous high or a previous low. The number that I'm actually looking for is a 25% zone, 25% above a previous high or 25% below a previous low. Why 25%? Because statistically, we have found that if price is going to fail or reverse, this is the area where it's most likely to happen, okay? So this is the area of the false breakout. It doesn't have to be exactly 25%. It has to be within the zone. So let's see what that looks like on a chart. All right, so that's the homework chart. Hold on. I'm going to get to that in a second. I don't want to show you that one yet. I want to go back to the spider. Okay, so here, right, I'm looking at swings. A swing is just basically a high to a low, okay, or a low to a high. That's a swing. Right now, the market's closed here, so I don't know if this is going to be the highest high. We have to see if it turns. If the market turns, then I have a defined swing, which I can measure. Okay, but as you can see, I have 2 points here. I have a high and I have a low. The high and the low, those are reference points, all right? So I can define an area, 25% above or 25% below. Now, this swing, these 2 swings are the most recent. So if I measure them, they're going to give me levels in the future. But let me show you a level that's already in place. It's already historical. It's already after the fact. Look at this swing here, that high to that low. If I had measured that, okay, and I have my 25%, look at where the market failed, okay, inside this zone, which is 25% higher than this high, okay, which is the 199.90 to 202.34 zone. If I have confirmation in that zone, then I have a good idea that that's where we're going to fail. All right, now you can see it spent some time in there. It spent some time, but it gave us some structure, a little double top. All right, I'm jumping ahead here. That's when we get into validation. But as an options trader, what if you knew, like Tom said earlier, what if you knew what the market is more likely not to do? Well, in this zone, it is more likely not to go up, right? And it's more likely to sell off. If you knew that and you knew the numbers, the range, right, the zone where you were in, then you can consider strike prices, up in this area somewhere, right? Obviously, if you just short straight calls, you're going to collect more. If you want to be a little bit more conservative, you put on your vertical. All right, I'll talk more about that in a second, but that's the idea. So you have your zones identified ahead of time, not while this is happening. But when it starts to happen, that's when you can start taking the positions because you already have an idea. You don't want to just step in front of something. It is possible that we can blow through the zone. That's why we wait for price action to confirm, and that's the third step. But let me just mention this. Okay, so I talked about this zone. That already happened. Okay, so this is over. We have new reference points now. So I'm going to erase this stuff, and let's talk about moving forward. And this is the type of analysis that I do on a regular basis, and I do this on very short-term type of trades. So I measured this high to this low, that gives me this zone moving forward. All right? That is now an active resistance zone. If we go up there and we fail, what is that? That's a false breakout if we fail. There's a higher likelihood that we fail up in there. I mean, maybe we don't. Maybe the market's strong and maybe we blow through. Okay, but I'll let the market tell me that. If we don't blow through and I get a validation up there, that's a sign for me to sell. Okay, now keep in mind that if you get a turning point up there, it doesn't always turn and give you a major reversal and sell all the way off. We can't always expect that, especially since this thing has been generally bullish on the biggest picture. But what if we reverse up there and we just pull back, 1% or something or whatever, and it starts to waste time, which as you can see it did in here, right? It wasted time. With your short options, you're collecting that, okay? You're collecting that time. Now, I'm going to throw it in there now. For a technique like this, I would work mostly with weeklies than with monthlies because I want that time to evaporate quickly, all right? In case the market does want to go higher, I still have a chance to take a profit on that time decay. That's the whole idea. So, I prefer weeklies, 1 week out, 2 weeks out, something like that. Monthlies are going to be a little bit more risky unless you have a very, very, clear level and you're going with the trend. Then I would be okay with a monthly, okay? So we'll talk about that when we're talking about conservative and aggressive in a moment. Back to this zone idea. So that's my resistance. What about my support? I need to measure a swing. Well, I have this low and I have this current high, which I don't know if this is going to be the high. I can measure the swing now, and I can say, okay, look, I have this little zone, right? And these zones are going to be proportional to the range that you measure, obviously. So if the smaller the range I measure, the smaller the zone. The larger the range I measure, the larger the zone. It's all related to the volatility, basically, okay? Because that's what ranges are. So I have this zone in here. That's my support zone, and that is 177.14 by 181.80. That's my support zone. The problem with this is I don't know if this is my high. This is my high right now. But what if we pull back tomorrow? Then that'll be an identified high. What if we go higher tomorrow, which we can do? Then I have to redraw this, okay? So either way, if I have to redraw or not, it doesn't matter. You know why? These are zones to anticipate. I'm not reacting. You can see this zone is not in play right now. All right, I have to wait a long time before it gets back there. I may have to wait days or a week. All right, but do you see it puts you in a position to anticipate. It puts you in a strong position right from the start because you're anticipating, you're not reacting in such a zone. Same with this resistance. You're anticipating, so you're prepared. You're not reacting. Reacting causes a lot of problems. We're trying to capitalize on people who react. Okay, so that's basically how you project forward. Now, keep in mind that there's also a level of context involved, and that's where really a skill of a discretionary trader comes from. That's why I gathered the information earlier. If we're in an uptrend, we're more likely to break this zone up here. Even though it's a resistance, even though we may hesitate, we are more likely to break higher. I need to be aware of that, okay? So I know how to adjust accordingly with being my, aggressive or conservative. Okay, so this is step 2, levels, all right? I identified levels. Keep in mind, there's more to this. This is the simplest, easiest, fastest thing that I can show, okay? And these extreme prices are high probability. All right, so let's go to the third step. Remember, if you have questions, you can ask, or I'll just wait for the Q&A. But the third step is validation, the validation process. This is probably the most important part next to finding the levels. Now, there are 2 ways I like to validate. I use price action candlestick patterns, and I also use price action structural, which means I'm looking for formations. You can have a combination of both, okay? I saw a question in there. Let me finish my point, and I'll answer that question. So, again, when we're validating, we're looking for very specific patterns and conditions to prove that we're not the only ones taking this position. Now, remember, I'm coming to you from the perspective as a day trader, so I'm making these decisions very quickly. As an options trader, especially if you're looking at the broader time frames as a swing trade, especially for swing trades, you have more time to make these decisions. you have more time to play with the price action and try to get better prices. I don't have that kind of time, but you will, because these things take longer to unfold. Remember, you may not see some of these patterns unfold. It may take, you may see 1 or 2 per week, maybe, because of the amount of time it takes for these things to reach these levels, okay? But when it gets there, you're ready. You have something to do. So it takes some time and effort to monitor these things, all right? Context is basically, putting into perspective all of our other information, in light of the level. Are we more likely to break this resistance level or support level? If so, what does that mean for my position? Should I take an aggressive position? Should I take a conservative position? What am I expecting? Context comes into play all the time, okay? So I'm always considering these other variables at the same time. That's why I gather information each step and I use it all at the same time. Now, the other big thing is stop, right? Where do we place our stops? As an options trader, you don't necessarily have to worry about stops unless you're in the straight option, right? If you're long options, obviously your premium is your stop. You can just let that go unless you want to manually control that somehow. But if I was trading the option, I'd be like, all right, the premium is my risk. That's it, okay, my long option. But if I'm short, that's a different story, right? So we have to have a way to either put on something else to adjust the risk, basically turn it into a vertical if I'm short a call or short a put, okay? Or just, again, get out of the position, all right? Or if you're dealing with a stock, take delivery, which I've done also, depending on the stock, because I don't mind. If I'm short a put, for example, I'm getting a good price anyway, I'll take delivery. I don't care. I'm not taking a huge position, so it's okay. The other consideration, of course, is margin. If you don't have the margin, then obviously, you have to be careful with delivery. So that's a whole different topic. But anyway, so stops, are based on structure, not on some arbitrary number. I don't say, well, I'm only comfortable losing 1%. That's not going to work. The market doesn't care about your 1%. If the structure suggests that the stop should be placed around 1%, then that's different, okay? But it's not an arbitrary number. And what I mean by structure is, do we have some sort of, like, let's say, for example, let me go back to that chart. I'm going to answer your question. Just let me finish my point here. I keep going back to the wrong chart here. This is the one I want. Okay. So, for example, let's say this is my area I defined as my resistance, and, where am I going to put my stop? If the structure suggests, like back here, let me zoom up on this a little bit. If I'm looking at something that looks like a double top type of formation, then that suggests that, okay, there's some bearish structure up there. I don't want to put my stop exactly at that high. I am going to have to do a measurement to put it a little higher, right? We don't want to put our stops where everybody else puts them. As an options trader, you do have flexibility with this, so you don't always have to worry about straight stop orders. You can put on an adjustment or something along those lines. But just keep that in mind. It's based on structure, not an arbitrary number. Okay, so let me go to your question now. I saw a question. Let me see. Okay, in the chat. Okay, so Peter, if you are choosing strikes outside the zones and decide to do weeklies, you're not going to get enough premium. It depends on the volatility. If the volatility is low, it will not be worth your time. Yeah, that is correct. Okay, but if the volatility is high, right? Remember, you're already at an extreme price. So you will have the ability to put on, to pick strikes that are closer, all right? You can almost, not at the money. I would do slightly out of the money. Depends on what instrument you're trading. But if it's a slow-moving stock, a low beta stock, then it's not going to be worth your time. The premiums are going to be like, 5 cents or whatever. But if you're dealing with something like Apple, for example, or something like Google, okay, or something crazy like that, those high beta stocks, or the S&P, the way it's been, the craziness that we've seen in the S&P. I haven't looked at the VIX or the volatility, but I'm sure it's spiked. One day there's a 65-point range in the S&P. That's nuts. I haven't seen that in the future in like forever. So when you have something like that, you're going to have fat premiums. When you have an extreme price and you have relatively high premiums, it's a great way to do this. Keep in mind, extreme prices aren't the only levels. There are other levels we can choose. It's beyond the scope of this. I can't go into that now. I'll be here forever. Okay, I'm just giving one example. Remember, there's more to this methodology than I'm showing you. It's just I'm trying to give you the basics very quickly so you have an idea of how this works. Okay, so I hope that answers your question. Any other questions real quick? Because now I can talk a little bit more specifically about options, okay? So what I did was I outlined for you how the methodology works. There are 4 steps. I covered 3. The 4th step, of course, is trade management. As an options trader, obviously, you're going to let the market do a lot of the work. You don't really have to think as much on your feet as an options trader because you're letting time take care of things for you, especially with the short options. If you're long options, then you need movement now, obviously. So you're going to have to keep more of an eye on things and be prepared to take profit much more quickly than you are if you have your short options. Okay, so again, the best methodology, or the best strategy for using this type of technique, of course, would be long or short options, straight calls or puts, or credit spreads. The question is, how do you select your time frame or time horizon, and what strikes? All right, so let's go back. Let me pull up an example now. This example came from one of my trainees, this guy Jacob. He always sends up these great charts, and this is J.P. Morgan. Now, J.P. Morgan's obviously, it's not known as a high beta stock, but this is the example he used, and you'll even see the premiums, okay, the low premium. And this is a homework assignment that I assigned him to basically show me how they would, select their strike prices and everything else based on the whole thing, right? So here's what he writes, per current prices, we are risking 50 cents while taking in a 6-cent premium. That's not really good, obviously, reward to risk-wise. Now, granted, the price has yet to confirm I would like to get more premium, but this seems to be a good example that may play out in the near future. So, again, keep in mind, he was just trying to show me an example, right? So, obviously, in reality, you're not really going to be interested in a 6-cent premium. This is a low beta stock. But look at the structural example, and that was really the premise behind the homework. Here's your setup. You have the push lower. You have the retest of the zone. This is your 25% zone. He labeled it the sell zone, okay? Look at his strikes just outside the sell zone. 61, okay, sold a 61 call, and he bought a 61.50 call. So he put on a vertical spread, right, a bear call spread. Now, of course, he would have taken in a much higher premium if he just never bought that call. Keep in mind another technique that you can use to reduce your margin requirements and take in more premium is don't short the next strike out. Don't buy the next strike out. Buy a deep out of the money call. That, in the eyes of the broker, you're covered. So that will reduce your margin requirement dramatically. Because, of course, when you have short options on, especially if they're naked, I think it's like, what, 20%? I think they want of the underlying or something like that. So, with the expensive stocks, that can be very difficult. Yes. I'm sorry?
In Reg T, yes.
Oh, okay. So yeah, when you're dealing with stocks, and I believe that's how it works with, the retail brokers and stuff. If you don't have a large account, it can be difficult. Your margin requirements could be very high, and, it ties up all your money. But if you buy a deep out of the money call, it's not exactly helping you with your risk, but it is lowering your margin requirement, okay? In terms of risk, you have to think of that as a naked call, all right, if you have a deep out of the money call. The whole idea is just to collect more premium in this case. But as you can see, he was looking to put it on as he was getting validation in here. Now, I didn't talk a lot about validation, but there is a candlestick validation in here that he used on his 4-hour chart to basically tell him it was time to get in or time to open up this spread. I personally wouldn't have done the long call. I just would have done the short call and then work with that because I can, I can monitor this thing all day. But look at his target, okay? He had a reasonable expectation. This thing was generally making higher lows and higher highs. So just in case the thing is going to go higher, which is very possible, he was looking to get out at his 618. That's what that is. This is a 618 retracement. That would be a good place if he was actually in the stock. But think about it from a time premium-wise. If this thing just pulled back a little bit and spent a few days pulling back, your premium, especially on the weekly, would just vanish. It would just evaporate, okay? Maybe 2 weeks out. It would really take, the premium to really, decline dramatically, and you would have plenty of opportunity to take something out of this, all right? So again, you want to focus on higher beta stocks or, futures contracts that offer more premium that are worthwhile. But, like I said, it's a good place to anticipate where these things can turn. If you really want to be aggressive and, you're doing with the side of the trend, you can do at the money, okay? A lot of times this technique will put you counter to the trend. But for example, what if this thing tested the low? We've identified this thing as a bullish trending thing, for example. and you're pushing the low. A lot of times, the breakout traders get caught in that low thinking the trend is reversing. Of course, it doesn't reverse. It's a false breakout, and now you get to squeeze back to the upside. If you're on the side of the trend, you know, you have a high probability that this thing is going to go fast and far in a relatively short period of time. So in a case like that, you can use a more aggressive time horizon in terms of buying more time or selling more time, like a monthly in that scenario. So do you see the difference? If I'm going against, a weekly might be more appropriate, or maybe sell 2 weeks out, right? Because I'm being more careful. I'm trying to take advantage of a quicker time decay so I can get out faster, right? Because this thing may turn on me quicker. But if I'm going with the trend and I'm anticipating that this thing should at least retest a high, because something that's making higher highs typically should at least retest the high or at least attempt to go higher if it's strong, that's the likelihood, then why not get a monthly, okay? Or why not buy a call instead of selling a put? Why not buy a call and let the market do the work, all right? If we're in that type of, it's a high beta stock, or we're in a very range expanding type of environment. Volume can also help with this. If you look at the S&P volume, some of those days it was trading like 500,000 contracts per half hour. I haven't seen that in a long time either. We average like around 100,000, 200,000 per half hour. That's the way I look at volume. And when you have that volume expansion, obviously you're going to get greater ranges, right? Because there's a lot more activity going on. So these are all part of context, things to keep in mind. Okay, so that's basically how I would handle a situation like this. This is a nice homework example, just showing you the structure and showing you, how this would work option-wise. Okay, let me see. How am I doing with time? I still got some time. So as far as, do I have another question here? Okay, hold on a second. I didn't see this one. I got a couple of questions. Let me answer. So any specific reason why you use a 4-hour chart instead of a 1-hour chart? Well, yeah, that comes from Forex trading. But, I use the 4-hour chart because I like it as a nice alternative to using a daily chart. It just gives me more detail. And I'm always looking for structure, and I'm looking for price confirmations and price validations, and that really has to do with the candlesticks. So I need to see candlesticks. That's why I use the 4-hour chart. The daily is going to hide more of that detail. For some people, that's good, but for me, I need to see the detail. So that's why 4-hour charts. And as a swing trader, that's the magnitude that I would work on. You can use an hourly if you want more detail, but I use that more for day trading. The hourly, the 30-minute, the 15-minute, those are for day trading. For swing trading options, a 4-hour is good because it gives you enough perspective, and it gives you the magnitude of movement as well. I don't really want to be trying to trade an options trade on the magnitude of a 1-hour or 30-minute chart. The moves are going to be too small, for what I'm trying to do, because I need time. I need more time, right? So the 4-hour will give me that magnitude. I've heard 4-hour charts are good for trading Forex. So yeah, they are. I mean, that's because Forex moves in a different way, and it's kind of, these currencies, a lot of times they take forever to do things, and there's a lot of noise, especially on the smaller time frames. So the 4-hour basically consolidates all that noise and allows you to see things more clearly, especially in a trending environment when it comes to the currencies. If you're placing income trades where the holding period is normally 30 to 50 days, okay, well again, 4-hour or above. I mean, if you're looking at 30 to 50 days, you could use daily or even weekly charts. Keep in mind, when you're using that level of time frame, setups are going to be even less frequent. So, you may not have a setup for days or maybe weeks. It may take like 2 weeks for you to finally say, oh, finally we reached an extreme price zone, and then you have to wait a few days for the validation. Like, it's a very long process if you're doing that type of thing. That's why I like to employ this on very small time frames, because I like the frequency. That's me. But if you just like to take your time with things, and it doesn't matter that it takes 2 weeks, then that's the type of time frame you'd be looking at, daily or weekly. A 4-hour can work too, but that's more for like days. It can take days for setups to unfold and to even emerge. Okay. I hope that answers. Does that answer your question? So, I just want to touch on the strikes. Again, when you're dealing with the strikes here, this technique gives you the benefit of being closer to the price action because the zone already represents a high probability turning point. So if you're just outside that zone, whether it's one strikeout, depending on the instrument, because some of these things go 5 points at a time, whether you're one strikeout or, a few points out in terms of strike, that is going to give you the best premium because remember, the market now has to work even harder. It has to work even harder to get you into trouble. All right. Now, I'm assuming we're naked. We're naked options at that point. If you have your spread on, then your risk is reduced even further. But, of course, you want to make sure that premium is worthwhile. Sometimes the market may come to your strike very close and then not exactly touch it or just touch it and just fall off, and then the time value decays so quickly that you have a chance to get out for a profit. Let me tell you a quick story. I once did this with Google. When Google was trading like, I forget, 1,000, 1,200, whatever it was. It was something, up there before it split, right? And I had, with Google, you have to know how this thing behaves. So a near the money strike for me was 50 points out, right? So I saw a setup on Google, and I put on, I think it was a short call, some short calls on Google, 50 points out of the money, based on where we were. Now, of course, this was just after earnings, okay? When it comes to stocks, you need to be very aware of the earnings because that's when you get the gaps and this and that, right? So it was just after, and I said, oh, Google didn't have a crazy reaction just after earnings, so I don't have to worry. But I noticed the premiums were still very high, and that was unusual. But I'm like, hey, you know what? Maybe they're not noticing something, so I'm going to put this trade on, right? I didn't realize that people were anticipating a split announcement. And of course, it came out the next day. That explained why the premiums were so high, right? Now, it's a good thing I was 50 points out of the money because the thing gapped 40 points. Now, instead of it being against me, once the volatility fell apart after that announcement, the trade was actually in my favor, because of that, because it was a weekly. And I was like, wow, it's a good thing that I knew enough to put it that far out, and it's a good thing that, I did it selling premium instead of buying premium. Hold on a second. All right, just hold on 1 second, 1 second. Okay, sorry about that. Yeah, so anyway, so like I was saying, if I didn't have that time value protection in that sense, the thing probably would have been against me. But even if it went against me just a little bit, right, maybe if it went 10 points against me, I still have that time value decay working in my favor because the premium was so fat the day before. All right, so anyway, there's a lot of advantage to selling, options in that sense. I know it's a crazy story, and a lot of people probably wouldn't have done that, but I did it. So anyway, all right, so I have about 15 minutes now. This is pretty much the presentation. I went through this very quickly. So now is a good time for Q&A, I think. So if you have questions, and while you're coming up with your questions, I just want to mention a few things. All right, for those of you who don't know, I do run a weekly group mentoring service. It's called the Traders Workshop Series. All right, I'm just going to mention this while you come up with your questions real quick. Just want you to know what I do. And in this series, I teach people how to develop their skills, using this exact methodology. Now, at this point, I have 20 hours of recorded training, which, people have access to, and I do my weekly real-time group mentoring every Thursday. In fact, I did one today at 1:30. It's for an hour on Eastern Time, 1:30 Eastern Time every Thursday. That's when I conduct this. And I have my people come in, and we go over different things, either specific topics, or we go over reviews where people tell me how to analyze and trade the market, and I basically evaluate them as we go, okay? Just so you know, the special announcement that I wanted to make today is I'm closing the membership until next year because I have a lot of people already, and it's very time-consuming for me to maintain. So, I'm going to make the opportunity available for attendees here today, but I'm closing it. So, the only way to be able to get to this is, okay, the only way you'll be able to get to this is by emailing me. All right, and these are the prices. I don't have a sales page. I don't have anything like that because I'm not, into marketing and stuff. But what I'm doing is I have a deal where it's $397 for 5 months. It's for attendees today only. That comes to $79 a month. Like I said, I'm closing this service. So I'm going to open it up again next year. If you want to take advantage of this price, you can do it today. You get 8 hours of training per month. I'm just going to do this quickly because I'm not, doing sales here. You got four pre-recorded. That link is sent to you by email, and you have 4 real-time with me, which also get recorded and eventually get sent to you. After today, the price is obviously going up. The only way to get to this is you have to email me. It's the only way, because I don't have a sales page or anything. All right, so my email is principatofx@gmail.com. If you're interested in this thing, just let me know, and I'll send you the link from there. If you're interested in just checking out an idea of how other things work that I do have this free session which you can get if you just go to this link, unconventionaltrader.com, and you can go there, and there's a free video that you could sign up for, and you can see, it's a blog post about, how to be consistent and all that kind of stuff. Okay, so it's an interesting blog post. Check it out. You could sign up and get a free video from there if you're not sure about this or whatever. If you don't think it's right for you, check it out. One other thing I want to mention is with Capital Discussions, I'm going to be starting a swing signal service. This is going to be free, for the month of November. And basically, I will be looking for these signals across different markets. Everything that I just showed you just now, I'll be looking for signals. All right, so it'll be in crude, S&P, Dow, NASDAQ, the futures, currencies. Wherever I see it, I'll mention it. All right, and then it's up to you. I figure how you want to work with that options-wise, or if you just want to take the straight underlying contract, whatever. But we're talking about just putting this service together. Like I said, you want to try it out. You can just go to this link right here. Swing Signals there. It's cdurl.us/swing signals, and you can sign up there for free. Okay, and it's going to go out by text message, by email, by all these things. They're very good here with their automation and stuff, so everything should be smooth. Anyway, just wanted to mention those things. All right, so questions? I'm ready. Did you want to say something, Tom?
Yeah, Brad asked this, the signal thing, is that going to be the same underlying? I think you talked about futures, the symbols, right? Like ES, NQ, stuff like that.
Yes. I'm going to be covering a multitude of markets. The financial futures, S&P, Dow, NASDAQ. I'm going to be looking at some commodities like oil, gold, possibly. And I'll be looking at currencies, euro, pound, franc, those kind of things, because that's where you find a lot of these things. I mean, if people want me to look at stocks, I'll look at some high beta stocks like Google and Apple, but I'm not going to be looking at like thousands of stocks. This is mostly isolated more toward like futures, futures contracts and things like that. But since, this is more leaning more toward options traders, yeah, I will look at high beta stocks since, I know a lot of guys like to trade options on those things. Okay,
Mark,
so that's the idea.
Have you ever looked at the futures on the VIX?
No, you know what? Tom mentioned that the other day, and I have not. That's a market that I just haven't really considered because I just haven't. It's just not on my radar. But I can look at that because this would apply just as well. If there's futures contracts trading there, and there's people, trading, and there's emotion involved, yeah, I can totally look at that.
Okay, Mark. One of the things that we'll take it offline because the VIX, what we found in our research, has the greatest daily volatility versus the least amount of longer-term volatility, meaning it spins its wheels a lot, it has a lot of ranges, but it tends to have the greatest reversion to the mean properties versus a lot of, movement in the much shorter term. So it would be interesting that, when they get their breakouts. So why don't you and I take that offline? Maybe we can end up having that during the free month. We can work together to be able to end up offering the folks something.
Yeah, I would love that. Yeah, that would be really interesting. I'd love to do that.
Good.
Okay, yeah. So thanks. Thanks, Jim. And let's see, I have a question. Daniel asked, what about the close of the 4-hour candle? New York close, or does it matter? The close of the 4-hour candle, well, closing prices are important to me. But, when it comes to validation and formation, I'm actually looking for price action validation based on candlestick patterns initially, and then I look for structure. So the 4-hour close, it really depends on how the candle closes, and it also depends on the high and the low of the previous candle, right, for me to actually enter the trade, if that's what you mean. But, for options trading, the precise entry is not going to matter as much as it is for me because, price is like very important for me. It's going to affect everything that I do. You have more flexibility as an options trader because a lot of times you'll just be dealing with time. As long as the market wastes some time, you're good. Even if it starts to go against you right away, as long as it's wasting time, that's going to work in your favor. Do you mostly do this on indices or stocks or a mix? Well, for my own trading, I mostly do this on the indices, mostly on futures, okay, especially like ES or crude or things like that, these highly active futures markets. I've done it with stocks. The only thing I don't like about stocks is when I'm trading the underlying stock, the margin, like it's a pain because it's so consuming, especially these high beta stocks. It's like I get better leverage with the futures. So that's why, I focus more on the futures. So let's see. Is it usually the same underlying over and over again? Yes. A lot of times it is. But like again, for purposes of the service, I'll be looking across different markets because sometimes you don't have a setup for a long period of time. ES may not show me something for a week or two. So I'm not going to just say, oh, well, I have no signals. I'm going to look at other markets, obviously. Okay, because usually you can find something somewhere. Yeah, that's my email address. Thanks, Tom. So yeah, if anyone's interested in my thing, my service, or that whatever, I also do one-on-one training. I do a lot of different things. Again, I don't have a sales page. So if you'd like to know more about that stuff, just send me an email. I'll respond right away. Is your Forex on SMB no more available? Because I'm a Forex trader, not an options trader. Well, no. If you're a Forex trader, then you can just work with my stuff. Just send me an email, and I'll send you more information about that. Okay? It's just better if you send me an email. So that's my email. You have it. Any other questions? So again, I'm running this special for attendees today, $397. It comes to $79 a month. That's cheap. All right. I'm not that cheap anymore, but I'm just doing it. I'm doing it for capital discussions because I'm very consumed. People are sending me homework. I have to attend to people. I'm doing one-on-ones. So my time is very consumed now. And when I first started this, I was had a lot of free time. So I'm like, okay, that's why it was cheap. But now I don't. So take advantage of this because I'm not going to after like this week really. I'm not taking any more members for this. I'm done with it. Okay, I'm going to keep doing it, but only for the people that I have until next year. All right. So anyway, just wanted to throw that out there again. Any other questions? Good questions, by the way. Any other questions? Any other questions about the process that I use? Any other questions about how this might relate to options? When I trade options personally, a lot of times, like I said, I like to do naked. I like to do naked puts, naked calls, because especially naked puts, because I like to take delivery of good stocks. That's just something I like to do. Of course, I can't do that really big, so it's kind of limited. I'm not very, my knowledge and experience with non-directional trades, especially some of these iron condors and things that these guys talk about in here, they're very complex. And my attention is very focused on my intraday stuff. So it's hard for me to be able to do everything. That's why I don't really do the non-directional stuff because I'm so focused on directional. I spent 14 years focusing on directional trading. So that's where my expertise is. Okay, question. Do you look at overall IV levels when placing trades? Actually, I don't because, I'm assuming that if I'm trading high beta, I'm assuming that the volatility is obviously going to be high. I want high premiums. So, I'm not playing any volatility games, really. I just want high premiums. I try to keep that as simple as possible. I know that can get very complex. So, no, I don't. I don't look at overall implied volatility levels. I'm just assuming it's high, okay? Especially when we're reaching extreme prices. A lot of times you get those inflated premiums at extreme prices. That's why this techniques work well with that. Thank you for saying that. I appreciate it. Some other presenters sometimes choose to ignore questions. Well, yeah, I'm not going to ignore questions. Any other questions? Any other questions?
Looks like we're running out of questions, Mark, but a really interesting presentation. Appreciate it.
Okay, great. Well, I'm glad. I hope everybody found this helpful in some way. I hope it helps you, look at the market a little differently, maybe focus on areas they didn't focus on before. And if you have any, if you want to reach me for anything, you have my email. I'll be happy to hear from you.
Looks like we had one straggler question from Brett. What's a typical premium received?
Oh, that's a good question. It really depends on the instrument. On a high beta, like a high beta weekly, for example, like Apple, I mean, a typical premium can be anywhere from like on a weekly, anywhere from 50 cents, maybe around 40, 50 cents, maybe something like that. I try not to go anything below 20 cents, 50 cents. If it's really crazy, or if I'm really at the money, it could get close to $1. That's more on the conservative side. Stocks like Apple, Amazon, Google, Priceline, Tesla, those type of stocks. That's something like, it's around around there. Good question though. Futures are going to be different. When I do this with options, I usually don't do it on the futures. I usually just do it with stocks because it's just easier. The futures get complex, especially with their deliveries and their span model, with the what do you call it, the margin requirements. So that's why I'd rather do weekly stocks when I do it. If I'm going to do a future, I might as well do the spider. If I'm going to do the futures, then. And a lot of times the spiders, the premiums aren't really worthwhile. Okay. Good question. Did I answer that question clearly for you? Is that a good answer? Okay.
Thank you.
Yeah, great.
All right. So I guess that's it then.
Yeah, we're coming up on an hour, so nice time management, and we really appreciate it. And thanks for coming on, Mark.
Hey, you guys,
Mark,
thanks for having me. It was a pleasure.
Thank you again for offering, our members, a discount, and the fact that you'll be willing to end up working with us so that the folks can end up checking you out for the month, I think is absolutely great. And we really appreciate you coming in today.
No problem. Anytime. Thank you. Thank you for having me again.
Talk to you.
All right. Thanks a lot.
Okay. We'll talk soon. Okay.
All right. Bye.
Bye.